After a week of mixed data, all eyes are on Friday's jobs report, and joining me today to talk about what to expect for tomorrow is Keith Bliss from Catone & Company. Keith, thank you again for joining me. It's a pleasure to see you again.
My pleasure.
Now, this week we have seen so much mixed data with the manufacturing for Monday, and then the ADP employment report Wednesday, and then now jobless claims. Is there fear that the markets are headed for a correction?
I'm not sure we're going to get the correction that people have been calling for the last 2 years. You know, every time I hear somebody call about a correction, it reminds me of that old joke, even a broken clock is right twice a day. But I think what you are seeing, which is something that we've been picking up for some time, is that the economic data here in the U.S. is not stellar. I mean, it's not moving in the right direction at the type of scale that we need it to move. We saw that manufacturing's been weak for some time, not just this week. Jobless claims numbers are still bumping along, in that 340 to 350 range. The 4-week average actually picked up today. There are some warning signs out there, so I'm anxious to see what the jobs number for May is really going to give us tomorrow. The estimates range all over the board, so we could see anything.
I think that's something that doesn't get talked about enough is the participation rate with the labor force. And for the past couple of months, it's been a little over 60%, which is the lowest it's been in about 30 years. And now we have new graduates coming into the labor force. So is this somehow masking some larger issues that are in the labor market?
Yeah, I agree with you. There are some structural issues inside of the labor market of the U.S. One of the things that economists always point to about the participation rate is we have about 10,000 retirees per day in this country because the baby boomers, which unfortunately I'm at the tail end of being a baby boomer, we're starting to roll through and retire right now. And that, of course, is having a dampening effect on the participation rate, which, of course, has the inverse effect on the unemployment rate. The fact of the matter is that whether you have 10,000 people retiring every day or not, the unemployment rate is not where it needs to be. The stated objective of the Fed with their easing policies is to get the unemployment rate down to 6.5%. We're currently close to 8%. They've got a long way to go. There are some structural problems inside of the labor market, in my opinion, transferring people from old line economies into new line economies. The president stated, one of his stated economic objectives is to re-energize manufacturing. I'm not sure he's ever going to get there. It's just a different way we work and we live today. A lot of the manufacturing jobs have gone away and probably won't come back. So there's those structural things that we have to grapple with, and it may take many, many years to get through them.
Right, and as you mentioned, the past few months we have seen that unemployment rate start to edge down from 8 to 7.5, but still, even if we do see it at 7.5 or even 7.4 tomorrow, there's still a problem when we do have so many people out of that part of the labor force.
Well, that's right. So you get the unemployment rate down one of two ways. You either affect the numerator or you affect the denominator. So if we affect the denominator all the time, are we still putting more people back to work? Of course not. Really what we need to do is affect the numerator, and having job growth, even if we get a good print above 200,000 jobs for the month of May, that's still not enough. That would take us, all things being equal, that would take us another 14 to 15 months to get that unemployment rate down to 6.5%, which, by the way, even at 6.5% traditionally is a pretty high rate of unemployment in this country. So there's a number of things that are going on. I believe what we're going to see in tomorrow's number, regardless of what it is, and then the messages that we get from the FOMC a couple of weeks hence, will be that they will still be in there buying bonds, pumping liquidity into the economy to try and get that unemployment rate, get people back to work and bring that down. And of course, that has the follow-on effects of what we're going to see in the equity markets.
Now, when the report came out for March, it was very disappointing, but then in April, those numbers for February and March were revised, and April's report was better than expected. Should investors be cautious about trading on one number about what happens tomorrow if it is disappointing or if it is good?
It's a great point that you bring up, because academic studies will tell you in the short term markets will move on economic numbers, but in the longer term perspective, they mean much, much less. The jobs number that we get every month has become the most overanalyzed economic data point that we get in there. And I agree with you wholeheartedly in that, because you have so many revisions around the number, the markets will react immediately on the number. It's good for a quick trade, but from a long-term trend standpoint, you really shouldn't go with the headline number to begin with, and you should wait along. Now, having said that though, revisions are important. The ADP number that we got yesterday has been, for the last few months, a pretty good indicator of what we're going to see from the jobs report. That got revised down from the prior month and was weaker for this month. So I'm not very encouraged by what we're going to hear tomorrow out of the Bureau of Labor Statistics on the number. I think we're going to see a weak number, which of course, the craziness of the world we live in will be good for the equity markets.